Do you know that only one kind of data actually predicted the great sell-off in 2020? People were able to foresee the event by using on-chain data. On-chain data gives you the power to make invisible hands visible. This is possible because blockchain offers openness, and why not make use of it? But first things first, let's learn what makes the invisible hands happen in crypto market. In conventional economy, people focus on three entities: the firm, the household, and the government to understand and overview the market, because they move and make market price. In crypto market, we focus on three major entities: exchange, miners, and whales. On-chain data is traces of all trades that happen within blockchain, and that must be a lot. Therefore, focusing on more meaningful traces like of the three entities is necessary. These three entities are important because of their scale. If one has a lot of money and spends it in millions, the impact of their consumption is much larger than the average people spending on the market. Just like that, the three entities hold more coins than other holders, giving them a potential to have impact on the market. Not only that, but looking into their movements give us a peek on how large holders are viewing the market. These three entities are important, but they control and represent different things because of their difference in interests and goals. Exchange is where actual trading happens. Market price is formed as a result of the activities that happen in the exchange. So we can say that exchange represents the demand side. Investors could buy coins by using their fiat currencies or their other coins. Point that you should be aware of is that there are exchange-owned wallets and individually held wallets. Unlike stocks, coins must be moved from individually held wallet to exchange's wallet in order to be traded in the exchanges. So whenever coins move in or out of exchange wallets, it could indicate buying or selling signals. Now moving on. There are two types of exchanges: centralized exchanges and decentralized exchanges. Centralized exchange is kind of a bank. Users must deposit their money to CEX's wallet in order to use their trading service. If the users want to store their capital and stop trading, they withdraw their capital and move it to a safer wallet of their own. Decentralized exchange, on the other hand, do not make their users to move their capital back and forth. They let users trade among each other, peer-to-peer. It seems like using DEX is much more reasonable, but people use CEX for convenience and to trade to fiat. Metrics related to exchanges refer to CEX because trades that happen through DEX contract already leaves traces on the blockchain, while trades that happen in CEX do not. Hence, we can only make educated guess about the trades that happen in CEX through metrics tracing exchange wallets' behavior. These data are exchanged in and outflow, reserve, and so on. And these metrics can hint major trading activities. Miners control the supply by mining blocks, and if they stop mining, the network cannot be maintained. Their main goal is to make as much profit as possible by selling the blocks. Therefore, there is usually a time gap between mining and validating transactions on the blockchain, because they would want to sell at a point where they can make the most profit. Also, since expenses are needed to keep mining, their stay in the market indicates they expect they will be able to make profit despite the spending. By observing their behaviors through metrics like miners' outflow and reserve, traders can find selling signals of the miners. And also, they produce network data which constitutes the fundamentals of Bitcoin stability. Whales control both supply and demand and exploit the market inefficiency they have created. This kind of behavior is also observed in traditional stock market, so whales are traditionally important entity. They have the power to swing and move markets, so looking out for their behavior through CQ metrics will be very helpful. You can check the whale's activities by monitoring all exchanges inflow mean, exchange whale ratio, and coin days destroyed. Also, CQ sends out whale alerts when there are unusual movements that may refer to whales. So to wrap up, exchanges, miners, and whales are three main entities that you need to know and look out for. Filtering their data from the others and visualizing it seems hard, but CryptoQuant can do that for you. Be smart. Use all of what blockchain has offered you. Look into on-chain data and analysts' comments on CryptoQuant.com.
This video is made for your understanding. For more accurate description, view our data guide.